We wanted to welcome you this morning to Merriman's quarterly investment update. We'll be talking about what's going on in the economy and the world and how that is impacting Merriman's investment strategies and kind of what our forward outlook is. For those of you who might not know me, I'm Kristi Grys. I'm the Chief Investment Officer here at Merriman. Today, I am joined by Jeff Barnett, who is a wealth advisor here at Merriman. He's a certified planning professional. He joined Merriman in 2018. And Jeff's kind of particular passions in the world of financial planning, not just of helping clients, is specifically with clients who have complicated tax situations, equity compensation, and sort of a new one for us is we're finding a lot of clients and prospects who have cross-border issues, want to move to Europe, have parents in Europe, Canada, and how to deal with the complexities of living in one country and having assets in another one. Outside the office, Jeff enjoys do-it-yourself projects around the house. I really wish he would come over and help me with those because my husband is not super handy. He loves to travel and he also loves to read the latest science fiction. So I will be doing a lot of the talking today, but know that Jeff will be interrupting if there are times I go off on a tangent. That's his job, is to make sure I'm clear. And also, more importantly, he will be monitoring the chat so that you can, if you have any questions during the time you would like answered, he will be monitoring that. You can write in your question. And if it's generally applicable, he will interrupt me and we will answer that question during the live session. Otherwise, if it's something specific to your financial situation, he may answer that just directly to you, or if you're a Merriman client, that we may have your advisor reach out to you, or feel free to reach out to your advisor directly to have any further conversations about any of the topics today, anything specific to your portfolio that we may not be able to cover in a bigger group webinar setting. So what's been happening in the markets, in the economy lately? So the big thing, kind of headline news in that world, is that the Treasury yield curve has been inverted for the longest time on record. Now, obviously, there's a ton of technical terms in there. So I'm going to start with, like, what is even the Treasury yield curve? Why is it being inverted for the longest on record of relevance? So a yield curve in general is the amount someone who lends money gets paid on an annual basis to lend out that money. And if you lend out money for 3 months, you get paid a certain rate. If you're willing to loan that money out for 2 years or 10 years or 30 years, because you're committing to the borrower that you're going to allow them to borrow that money for a longer period of time, in general, the amount they pay you for that privilege of borrowing money from you, in the case of the US Treasury, that you're loaning it to the US government, is more. Because if you are going to commit to have your money not accessible for 10 years, 20 years, or 30 years, you generally need to get paid more than if you're just going to commit to loan it out for 3 months. That makes sense, right? Like if you're going to commit money for a longer period, essentially take more risk, take more economic uncertainty, you should get compensated more. So in general, the rate you pay down here is lower. And then as you go out in duration, you get paid more and more. So generally, the yield curve, which is, again, how much you get paid for loaning money, depending on how long you make it, is kind of this upward sloping, generally kind of steep at the first and then more flat as it goes out. But generally, the longer and longer you go out, the more you get paid for loaning money. I think that makes sense. It's pretty logical. So, but then sometimes in history, the yield curve does what's called an inversion. And what an inversion happens is that actually investors are getting paid more for loaning out money for a shorter period of time. And So right now, as many of you have been experiencing, this is kind of the shape of the yield curve, which we've been recently in, is these lines. Cash is paying, you can more for having cash and loaning out your cash for a very short period of time, whether that means days or months. You're getting paid a higher rate than you are for committing to loan that money out for a longer period of time, 10, 30 years. How much it's inverted, that's kind of a measure, but in general, if you get paid more for loaning money out for a shorter period of time than you do for a longer period of time, that's called an inverted yield curve. So how can that possibly make sense? Well, the only times in which that makes sense is if one expects the market, the general consensus is that interest rates are going to fall in the future. Usually interest rates fall in the future because there's a recession and the Fed needs to stimulate the economy, and to do so, it makes borrowing money easier. And so the reason this happens, or is because the world, whoever that is, people who are investing, are willing to lock in sort of this higher rate for a longer period of time. Because you can imagine it's great to get paid 5% on your cash right now, but if in 6 months you're only going to get paid 1%, it's a lot better to lock in 4.5%, 4% for 10 years than get paid 5% for the first year and 1% for all the 9 years after. So it can make logical sense, but only in a world in which one expects rates to fall in the future. So an inverted yield curve typically, so this is a plot here of the ratio of the 10-year rate you get paid for loaning money for 10 years versus the rate you get paid for loaning money for 2 years. And you can see that most of the time it is positive. In other words, you get paid more money for loaning money for 10 years than you do 2 years. But a few times in history, this is back in the 60s and 70s, again in the late 90s, there have been periods where you get paid more money for loaning money for 2 years. So these are times when it's below this black line of an inverted yield curve. We are right here. This inverted yield curve has been going on for over 2 years now. And you can see that every other time in history, when this starts, there's been a recession that's followed this period, right? That's these gray bars here. Oh, I'm supposed to be using my pointer, my pen. My apologies. Gray bars here are recessions on this chart. And you can see each time, generally, some time after the yield curve inverts, the US has undergone a recession. So this is the longest time that we've had an inverted yield curve without a recession. So there's a lot of speculation in the world. There's been a lot of speculation for the last 2 years. There's going to be a recession. There's going to be a recession. It's going to come in 6 months. Don't worry, it's another 6 months. We're going to have a recession. That's kind of been the theme, and it's been driving a lot of what we have seen in markets today. But at the end of the day, we're now more than 2 years in. We hit the longest on record in March. We're now 4 months after that. There is no recession on the horizon. There will be a recession in the future. I don't know when that is, but no one thinks it's tomorrow. It's certainly, there's no indication that it started. And equity markets have gone up. So this is a perfect example of why there's no specific economic indicator. There's no prediction that comes true all the periods of time. And if one panicked, this is equity markets, they went up. If you went Terra, you said, oh, there's going to be a recession. There's going to be a recession. The market thinks it. I think I need to get out. Well, look, in this period of time, the global stock market has gone up 38% since the yield curve inverted. That's a lot of gains and a lot of value added to miss out on if you have not been invested, because some prediction markets were like, there's going to be a recession. So despite this kind of historic event and lots of headlines around this inverted yield curve, a future recession, inflation, all of those things, in the end, markets on average have gone up. There's been down periods, there's been up periods, but on average, they've done what markets have done historically, which is continue to go up. And it's a specific example of why we think it's really important, even though there may be doomsayers, even though there are problems in the world, absolutely, to continue every day to stay invested in the market, because on average, the market goes up. And in this period, there's been substantial gains. So now that's the global stock market. There's lots of complexities underneath, and I want to dive into that a little bit. Jeff, do we have any questions before I do that?
No, none yet. But
okay.
Guys, feel free to post them in the chat.
Wonderful. So while the global stock market has gone up, there have been a few areas that we're going to talk about that, as most of you know, we have, compared to the global equity market, we have an overweight to small value stocks, both in the US and international. And we also have an allocation to international stocks that I want to talk about a little bit, and how this period has impacted them, and how the economic climate has some interesting behaviors that we've been seeing. So in general, over this period of this inverted yield curve, so we're going to talk about this kind of 2-year period of, really interesting economic times, like not your most standard kind of way in which things happen. And one of the things that we've seen is that small cap value stocks have been much more volatile than the general market. And so this blue line here that you see, that's the S&P 500. This purple line that you see here, this is AVUV, which is the ticker for the Avantis US Small Cap Value ETF. That is one of our primary positions that we have in client portfolios in the small cap value space. And you see that there have been periods where that has outperformed the S&P, and other periods where on an ongoing basis it has underperformed. You also see that it goes up more and is more volatile. That has been primarily driven, in my opinion, by interest rate uncertainty. So this big drop right here, if you'll recall, that was March of 2023, just over a year ago. That was when Silicon Valley Bank failed, and the headlines were full of, oh my goodness, there's going to be a banking crisis. This is going to be a contagion. We're back in 2008. Kind of felt very doomsday on that deal. There was a bank run, right? People hadn't understood that. So market, small value, especially went straight down, almost there. It had struggled to recover from that. All these gains here were essentially wiped out, and it kind of went back and forth with the S&P 500. But again, you had that volatility. Every time there was good economic news, the small value stocks rallied. Every time there's been a little hint of maybe higher inflation or uncertainty, small value stocks went, kind of down. So we've seen them generally do pretty well over this inverted yield curve period, but with a lot more volatility than we have been seeing in the S&P 500. It's a little bit different than what we saw before. The other thing that I want to point out, and this is sort of interesting, is that while there's been more volatility, generally when the S&P was going down, they went down. When the S&P has been going up, they went up, maybe more or less, but there was very few times when they didn't go the same directionally, right? You see that zigzag pattern, up, down, until you get to June of this year. And in June of this year, there was a point where the S&P looked like it was going up, and US small cap value stocks particularly, but almost all the other markets globally went down. This is what we call a divergence. In other words, one asset class is going up and another asset class is going down in a different direction. So, however, and so if you'd looked at your portfolio at the end of Q2, you would have been like, man, like year to date, this looks kind of not so great. So this is just zooming in on that last piece. So this is the end of June, right? Small cap stocks were down maybe 0.5%. I don't have the number off the top of my head. And the S&P was up like 15%. That didn't feel very good at all. The thing about small cap stocks, though, in this period is, like, again, the ability to move extremely quickly. So since the close of the quarter in the last week, small cap value stocks, AVUV in particular, have gone from a negative return year to date to almost a 10% positive return in like the course of a week, right? Again, a great reason to say, if I looked here, things looks, not so great. I look 2 weeks later, oh, I'm pretty much liking what's going on in my world. It's possible this will continue. It's possible that this is what I call a catch-up trade, meaning that this pessimism that had happened in June was just way out of character. So I'm super hopeful that this will continue to go up and catch up. We think US small value stocks are undervalued, that they're a good buy. Who knows, right? Like it could be, we could have another period of flat down and then another jump up, right? But it's real important, especially in volatile stocks, that a lot of the gains can come in very short periods of time. So we always want to maintain some level of exposure to that. If there continues to be positive economic news, that will definitely continue to support this kind of rally in the short term. Questions on what's been happening in small cap value stocks? Okay, so we could just
Kristi, we haven't had
on.
any questions yet, but I was just curious to maybe ask you for a little bit more color on this slide. Thinking about the factors that influence the performance year to date of things like the S&P 500 versus U.S. small cap value. Have there been any specific headlines or economic factors this year that have kind of caused this divergence? And do we expect those to potentially change, or what might influence them changing in the next 6 months or 12 months or a couple of years?
Yeah. So I think always in the short term, the markets are driven by kind of like headline news. So the proximate cause, if you will say, the headline that seemed to drive this was the fact that there was really positive economic news, and by economic news, I mean inflation seems to be getting under control, which people speculate will result in the Federal Reserve dropping interest rates. So most of the nervousness about small cap value stocks has come, in my mind, in two forms. One is, again, you'll recall that there was this big bank failure of Silicon Valley Bank. Bank stocks are the one asset class that has yet to recover, regional bank stocks. And there is continued worry that in a high rate environment that there's more distress below the surface that hasn't come out with commercial loans, real estate loans, etc. Generally, the market overreacts to bad news and underreacts to good news. So, but in general, a lot of these regional banks are in the small cap value space. So that's one. Second of all, in general, small companies borrow more money than large companies, and they borrow that with different terms, right? If you're Microsoft, you can go out to a bank and they're going to loan you on very good terms, right? This is like someone who has a long credit history. If you want to think about the consumer independent market, if you're 50 and you have a super long credit history and you have a really solid job, you can get a loan at a good rate versus a 22-year-old who just started and has no credit history, has no job history, right? The bank is going to demand a higher interest rate. for the loan. So you can think of that same thing happening between small and large companies. It makes logical sense, but in an uncertain interest rate environment, and particularly a lot of small companies have floating rate loans, and so there's a lot of worry in the market about their prospects for paying back those kind of loans. So, and in general, I'm going to talk about this at the end too. I think there's a strong perception right now in retail investors' mind that tech stocks are the way to be, and those tech stocks are the big players in the market, and they're the ones who are going to succeed in the AI environment. So I'm going to preface another slide I'm going to show later that one should question that assumption, but I think there's a sense that the big tech stocks, maybe they're not going to be the highest performers, but they're much safer. And if you're worried about a recession, you want to be in a place of safety. Bonds are not yielding much. People don't like bonds right now. If you got to put your money somewhere, kind of the big US stocks have seemed the safest place to be. So I think those are kind of some of the dynamics that are contributing to that. Note that those dynamics are not, and I'm going to talk about this in international stocks as well, those really have nothing to do about whether these are good companies, whether they have good characteristics or they have good profitability, whether you can buy them at a good price. These are sort of macroeconomic things that are swirling around. And, you know, we always want to focus on buying the stocks of good companies because in the long run, that tends to be the thing that drives results. In the short term, there are a lot of these macroeconomic factors that can be short-term volatility, drive short-term returns. But we still believe that in the long run, buying good companies at a good price is still a strategy. And you just got to wait through all this kind of volatility along the way. And in the long run, that will play out.
Well, Kristi, so it sounds like, this short-term interest rate speculation, whether it's the actual cost of doing business while rates are high or the uncertainty around future costs and these things having bigger impacts on smaller companies, that's driving some of this year. But we had two questions come in while you were sharing. I think the most recent one would be great to maybe cover when you talk a little bit about FTO in a few minutes here. Just sharing kind of what at a high level, how much of small companies do we own versus large in the portfolio, and what does the strategy kind of look like this year in light of FTO and how we think about that? And but the other question that we got that I think clients frankly are sharing this question quite a bit, and we see it on the news this year, and kind of regardless of the economic factors that have influenced volatility in the first half of the year so far, looking ahead to election season, the question was, how do elections tend to impact small stocks and large stocks respectively? And do they behave differently around elections? So I think just this kind of general concern about what will the impact of the elections be on market volatility and outcomes through the end of the year.
Those are both great questions, and I have slides on both of those coming up. So if I can defer those to those upcoming slides, because I love it when the questions anticipate what I thought the questions were going to be. So we will cover that in just a minute here, both those questions. But with that, I'm going to jump to international stocks, because again, this is an area where I think there's a macroeconomic driver to a lot of what we're seeing in terms of international stock returns versus what's happening at the company level. And you made reference to it, Jeff, in this question, which is FTO is sort of our way of kind of trying to allow for macroeconomic conditions to influence how we think about investing, versus just going with what's a good company at a good price, which is a long-term great strategy. But again, as we'll see, and I think with international stocks, we've seen this same sort of macroeconomic influence on what's happening in markets. So I've shown this slide in a couple of different quarterly updates, but about a year ago, I think that was, I would say, celebration in the world of diversified investors, because it felt like the past decade was all about concentration, all about US growth, large stocks being the winners, and a diversified portfolio not yielding the rewards that we expect it to long term. And JP Morgan, they're one of the people who talk about trends in US versus international. There are a bunch of others, but basically international had started to do quite well compared to the US for the first time in over a decade. That has shifted lately. In the last year, we've seen the return of kind of this US dominant environment. But if you look under the surface, there are some really interesting things, I think, that might argue that things are going differently and that it's less about the dominance of US companies and their performance in the world and more about the macroeconomic environment. This is a super complicated chart, but I think I'm going to try to explain it in general. So in general, companies have kind of three sets of things that drive their earnings to go up, right? We have dividends, that's these blue. We have multiples, that's how much you pay for a certain amount of earnings. And then we have the earnings themselves. And so stock returns are generally made up of those kind of things. If you're investing internationally, in addition to the earnings, the dividends, the multiples, all of which are kind of driven by the performance of a company, you also have what's happening with the currency of that company. So if it's a Japanese yen or if it's in South Korea, the performance of that local currency relative to the US dollar. On average, over history, the difference in currencies sort of washes out, right? There's no actual long-term value in holding dollars versus yen, right? There's on average the currencies move around a whole bunch, but relative to each other, the world economy goes up. And so we don't expect any return from that currency difference. But over short periods of time, we can actually see very large movements. And because the US has weathered this high inflationary environment arguably better than any other country in the world, we've seen the strengthening of the US dollar substantially over other currencies. And so when we think about what's been happening this last year over here, when the US has returned, stocks have returned to dominance, we're seeing a lot of that driven not by the performance of US companies, but by the strengthening of the dollar against other currencies. So here, this column is year to date for Japan and for the US. And you can see that from an individual company performance standpoint, from an earnings, multiples, dividends, what the Japanese companies are doing on average, they're outperforming their US counterparts. And this is absolutely true. There are more international stocks that are having positive returns, earnings surprises than US companies. Japanese companies have been doing quite well. But actually, Japanese stock returns are all the way down here compared to the US. That's this little dot compared to this dot, big dot, because the dollar has strengthened so much against Japanese currencies this year. So while these international companies are actually doing quite well at the company level, the fact that the US has been able to weather this inflationary spike without a recession has really, in my mind, driven the dollar up and allowed the US stock market to get a sort of, from a US investor standpoint, get a tailwind compared to international investing. As I said before, currency returns generally don't stick. And over the long term, we expect mean reversion. Is that going to happen in the next 6 months? Is that going to be 5 years down the road? I have no idea. This is super complicated. There are many things that go into this. It's basically impossible to predict. But we are seeing international stocks being dragged down by the strength of the US dollar. And that has really impacted the returns over the last kind of two-ish years and resulted in US stocks returning to being a having a higher return expectation than their international developed counterparts. If there are questions specifically on international stocks, Jeff, maybe I'll take them now. If not, I want to talk a little bit about factor trend overlay and how we're positioned, since that was a question and something we have a slide on as well.
I think we can pivot.
Great. So to talk about that, so it's been actually 3 years on June 30th that we've had since we introduced our factor trend overlay into our stock allocation for many of our clients. Obviously, whether it adds benefit and how it's invested depends on exactly each client's situation, but the majority of our clients do have this factor trend overlay. And the motivation for this is exactly what we've been seeing kind of this year, which is there's the company level aspect of investing, and then there's the macro environment level of investing, and both can have a substantial impact on positive returns going forward. We believe strongly that it is impossible to predict macroeconomics. We don't think you can predict interest rates going forward. We don't think you can predict whether the dollar is going to be stronger than the yen. What's China going to do with their economy? Is Israel and Iran going to have a war break out in the Middle East, right? We don't think we have any ability to predict that. But our research, lots of academic research in the evidence-based investing world shows that there is what's called a momentum effect. And what I mean by that is that trends of strengthening in dollars, in countries, in what's going on in the market, what things are doing well now when it comes to sectors, when it comes to countries, this momentum effect, on average, when you look at time frames in the 6 to 24 months, tends to have a small amount of predictive power about what's going to happen going forward. Things that are doing well, have done well in the past, are slightly more likely than average to continue doing well. It doesn't mean that there can't be major shifts. We actually saw this when the Silicon Valley Bank failed. As we saw before Silicon Valley Bank failed, small value had been doing extremely well. It's a great example of where we are momentum. But then out of kind of nowhere, bank failures happen, and boom, clearly that was no longer the place to be. But on average, if there's not a storm that comes by and kind of shakes things all up, there's kind of, I like to think of it as a weather vane. There's kind of a prevailing wind. And our factor trend overlay allocates a portion of our stock allocation in the direction of that prevailing wind. And on average, there are more times in which we have kind of calm prevailing wind conditions, and that works, than we have storms. Any investment strategy comes through its storms, and there are going to be periods where the returns aren't what we want them to be. But on average, we think this has added value. So at the 3-year anniversary, I always think it's good to look back and see what's happened. The good, the bad. Again, that doesn't mean who knows for next year could be not additive. But overall, since inception, having the factor trend overlay has been a very small benefit for our clients, despite the fact that we had a major storm with Silicon Valley right in the middle of that. And we were in a hole, and the strategy had to recover from that. And you can see that over 1 year and year to date, both have been extremely positive in terms of FTO adding value to the strategy. Right now, FTO is allocated to large US stocks. So if you think about, to the question earlier, in general, our primary allocation, we obviously have a couple of different strategies, and different clients might have slightly different allocations. But on average, we have chart an overweight to small and value stocks compared to the market as a whole. And that is true whether we have, regardless of how FTO is allocated, we always have factor exposure to small and value and profitability. And we do that because, as we showed earlier, you can have a very short period in which you have a lot of gains in those factors, and you always want to have static exposure that's not changing allocated to that. We believe that, and that's what our academic research shows. But currently, our factor trend overlay is allocated to U.S. large stocks, so kind of the biggest, most well-capitalized stocks. That has been super additive to the portfolio, again, as you see, year to date and 1 year, and has allowed us to overcome sort of the losses that we experienced, or relative, it's not losses because we didn't lose money, but relative performance of having that factor trend overlay or not having it from the Silicon Valley Bank situation back a year ago. So if you look at right now, for our equity allocation, forget bonds, specialized other assets, about 25% of our equity allocation is to our factor trend overlay, and that's again in large U.S. stock position. And then for the other 75% of it, we have 65% in the U.S., 35% in international stocks. And in that 35%, 65% in the U.S., it's about 2/3 large, 1/3 small. That's 60-40. So we still have a meaningful allocation to small value stocks, and that has really helped the portfolio in the last 2 weeks, kicking off the third quarter.
And I think just the tail end of that question specifically was about investing in small cap stocks in the current environment with their kind of inherent volatility. And I just want to call out that volatility is not unexpected. Regardless of what the last couple of years have looked like for small caps, we expect these types of investments to have higher volatility, and we expect that in exchange for enduring that increased volatility, that we'll get a higher return over time and be rewarded for taking that additional risk. So the increased volatility, regardless of the divergence and how things are kind of been going in the last couple of years, that's a feature, not a bug. That's kind of in line with what our expectations are in the long run.
Yes, and I think, Jeff, you made those super excellent points, which is one, this is what we expect at small cap stocks, and that's why they have a higher expected return. If you're going to sort of stomach that extra volatility and that uncertainty, you're going to get compensated by the market for that. And for that volatility is uncorrelated to volatility in other parts of our portfolio. So this diversification actually gets you higher returns, but also we can, to a degree, offset that volatility by having different assets throughout the portfolio, having specialized assets, having bonds, right, to manage that volatility while all still trying to take advantage of the upside potential that we think small value stocks provide. But yes, that's a feature, as you said, Jeff, not a bug.
And Kristi, we actually had a couple of questions come in about the international and just kind of world trends while you were covering FTO. And I think too, on the FTO side, it's like right now we're in the U.S. big companies, but that might shift in the future as these trends change. We might weight more heavily internationally.
Absolutely.
Is there you mentioned that right now the dollar has been strengthening, and some of that is just kind of a reflection on what's going on with our economic response to higher inflation and avoiding a recession so far and kind of achieving this sort of soft landing scenario. I'm curious if there's been any trends that you've seen for inflation and interest rates in the rest of the world versus us, and that was a specific question that came up. And then also, is there any way to invest in international companies without necessarily experiencing the currency drag and someone specifically asked about, is there a way to like purchase the shares in, I think USD was the specific question, but
Yeah,
I think that's something that you can touch on.
yeah. So I'll try to answer that and then go back to sort of what's happening in the world. So absolutely, you can invest in hedge strategies. So basically, those types of funds do what's called hedge out the dollar risk. So they purchase basically contracts that allow them to negate out the positive or negative movements of the currencies. So how does that work? Well, essentially that works by saying we're only going to get that exposure, but there's a cost for buying those hedges, and there's a cost for doing so. And so there's kind of a drag associated with hedging a portfolio. And given that over the long run, we expect no positive return from the hedging. All you're doing is paying to reduce volatility. And so we generally don't think you need to pay to reduce volatility. Like it's, as you said earlier, Jeff, it's a feature, not a bug. Like that's a mindset we need to get into, but there's no reason to pay for something that isn't adding any value to your portfolio. And actually, in many cases, the fact that US stocks go up and international stocks go down, or vice versa, over time, that the fact that they have different behavior is actually additive to the portfolio, because we can do what we call rebalancing. So we can buy international stocks when they've gone down and sell US stocks. So we can sell high and buy low. And actually, by having them move differently, we can actually take advantage of that, we believe, and add a small amount of value to the portfolio. So you can either hedge it out and pay money, or you can take advantage of it in terms of rebalancing and actually get a little bit of tailwind to your returns. So we specifically choose not to buy hedged international strategies, even though they're widely available. But it's a conscious choice on our part, because we think that is a better approach to investing. So where are different countries going? So the US so far has, again, been able to weather this storm the best. I think the Eurozone is, depending on who you say, is experiencing a mild recession and probably coming out of that. In general, all the central banks have been able to manage this inflation spike, I think, better than anybody thought. So the US is may have the softest landing, but in general, the world has been fairly successful at managing this. I think there's a lot of speculation about that Japan may have the most favorable interest rate, demographic, central bank environment that it's had in decades. They have a new central bank governor. They're finally, after 30 plus years, have recovered from the bubble in the Japanese stock market that ended in the late 80s. So there's a lot of positivity about, I think, in general, about Japanese monetary policy getting better, far better than it's been in decades. I think speculation, and again, this is pure speculation on my part, and frankly, other market participants. China, on the other hand, I think there's a lot of concern that they are willing to stimulate their economy, possibly at all costs, and that there's a lot of debt issues and a lot of monetary policy issues that may make it a headwind for them going forward. So, but a lot of that's already priced into markets, right? Markets are forward looking. They're already pricing in pretty pessimistic scenarios for China. So I don't take that as that, the prospects for Chinese stock market isn't necessarily that bad, in that like it's been hammered already pretty hard based on this worry about forward-looking fiscal policy. So hopefully that kind of touches on the question.
Definitely. And I think too, the focus on Japan, just to share a little bit of context, Japan is the largest part of the global equity markets outside the US and makes up about 6%. And so where their equity markets are going, that has a big impact on the global index.
Huge. And it's already, so if you look at just sort of a price that you pay for a certain amount of earnings, let's be currency agnostic, like US small value and Japan are two of the most attractive portions of the global stock market from a valuation standpoint. Japan has moved, the Japanese market has made a lot of gains, but it is still very attractive from that standpoint. And never any guarantees, but and we've seen the price to earnings continue to fall in developed markets in Japan, but the farther they fall, the more attractive those returns become, and forward-looking prospects become. Again, zero predictive power over the next year, 2 years, but usually has been a fairly good indicator of long-term prospects. So we will see, but just the fact that the Japanese companies are doing so well, more Japanese companies again are having positive earnings surprises than U.S. companies. The U.S. market right now is done really well from a return standpoint, but most of that is the dollar and a few companies, right? A few companies at the top, but 20% of companies are driving returns, doing positive, and the rest of the market is treading water at best until the last few weeks, which has not been true internationally in general over the past 2 years. Okay. I think we did that. Let's see. I think in the interest of time, I'm going to skip that section and just talk a little bit about where we are, what's going forward, and get to that all important question of the U.S. doesn't have an election. It's been a lot of constant news the past month. Not things I don't think all of us totally expected. I think we think everyone thought they knew what was going to happen in this race, and there's a few curveballs being thrown. So we'll talk about that. But where are we? Basically, I think there's starting to be a growing momentum that this thing called a soft landing might actually be really achievable. And market expectations, Fed expectations, the divergence in possibilities seems to be narrowing. That's always a scary thing to say, but I think if you were to take the uncertainty from a year ago, again, especially with the banking crisis, like that uncertainty is feeling like it's narrowing, and the consensus is building around that inflation is going to settle at historic levels. This high bump is actually going to be a post-COVID spike, and we are going to settle in at a reasonable nominal rate. Now, probably a nominal rate that's higher and probably positive real returns on fixed income assets. So not necessarily what we saw the past decade, but clearly not probably a very scary inflationary environment. That's, I think, if you were to say where are things going to settle out, each time we get monthly data, it falls roughly on this line and adds to the fact that maybe we're going to be at a plateau here going forward, right? So that's that would be very good news, and if that's really the case, probably allows the bull market and the positive returns that we have been going for. So I think that's kind of where things are looking like from a macroeconomic standpoint. Shocks to the system, they happen. They're not super frequent, but there's always that possibility. So we just want to keep that in mind and never bet, never put all the eggs in the basket of this is definitely going to be a soft landing, be all in, right? We want to always think about having some exposure if things go well and also having some protection in the portfolios. So the election. So I really like this chart. And there's a lot of I even do it. Election year volatility, right? Like whether that be large stocks, whether that be small stocks. It feels like around presidential election, there's a lot of volatility. And the reason that I like this chart is because it turns out that, as with many things, when you look at the data, that actually isn't what the data tells us exactly. So as with everything we try to be very data driven and very much not like, what's my emotional feeling? Am I worried about this? But what does the data tell us? And what the data tells us is these green bars are other years and the blue bars are presidential election years. And what we see is that, and this is a well-known phenomenon in investing, is that in the fall, in general, in the fall, when our election is in November, the fall has higher volatility. There's a saying that's like, go away in May. The summer tends to be, on average, more calm in the stock market. And then in the fall, driven by the calendar year of the US, fiscal years of companies, the fall tends to be more volatile. So might it feel like it's more volatile around the election? Yes, because our election occurs in the fall, and the fall tends to be the most volatile time in stock markets. But on average, stock markets have not been more volatile in presidential election years than they are in other years. Obviously, as we saw from the yield curve, averages of data are only as good as averages. There are times when anything can be different than history, right? Like there's constantly weather records being broken, length of bull markets being broken. So this is not to say that this year we're not going to have volatility around the election. But on average, there isn't something simply about presidential elections that causes market volatility either before or after an election. The one time when there is a bit more volatility in a presidential election year is sort of right in that period, that couple week period, and even probably a couple day period right after the election. And actually, that makes a lot of sense because markets are betting on uncertain outcomes and they discount every possibility. And right after the election, there's an uncertainty that's become a certainty. We're going to know who is elected. For better or for worse, however you feel, there's going to be an outcome that's going to be decided. And anytime there's a reduction in uncertainty, money gets moved around, right? There's great examples. Recently, the French election, you can see the markets move immediately when the results of elections become certain because a highly uncertain outcome has now been nailed down, for better or for worse. So it's fall. Fall tends to be more volatile. But in general, just because there's a presidential election, and we talk a lot about this, presidents don't drive immediate economic impacts. Parties, despite the fact that the Democrats and the Republicans all think that the outcome of the economy in the next year is driven by them, I'm sorry to tell them they don't. Long-term policies on, immigration, tariffs, taxes, those can have consequences. But world economies, the U.S. economy, are much bigger than any type of politics in the long run. For better, for worse, the U.S. has gone through a lot of presidents, a lot of different parties, a lot of different laws, and fundamentally remained at its core resilient to those types of environments. And I don't mean to minimize this, because I know a lot of people feel very strongly that there's worry about that. But in the end, there's no data that suggests that the U.S. economy will not survive either party being elected based on historical.
And I think too, the tail end of that question was around just differences in expectations around small stocks versus large stocks with elections.
Yeah.
And I think, Kristi, the takeaway here is that we don't necessarily expect the elections to have a long-term impact on equity markets either way, kind of regardless of the specific asset class. And we did get one more interest rate question coming in, just sort of asking about how quickly we would expect interest rates to fall in response to seeing inflation actually drop. And I don't necessarily know that that's a one-to-one piece, right? The Fed has a mandate to try to manage inflation and manage economic growth over time, and is adjusting the interest rate in response to that. And I think you called out something, Kristi, in your quarterly letter. You used the phrase "declare victory," and I think that that's perfectly apt in the sense that they declare it and they can move the goalposts. And we don't necessarily need a specific level of inflation for them to decide, hey, we're happy with where we're at this month compared to last month, even if it means no longer targeting that 2 to 3% range. And hey, now we're happy at 3 or 3.5 or whatever the number is. And so we don't necessarily know when they will start to ease off on the interest rate side of it, because we don't necessarily know where the goalposts will be in next month, let alone 6 months. But certainly kind of rates where they're at now are a little bit more similar to where they were in the 90s versus maybe in the last 20 years. And we probably won't get back down to zero like we did in response to COVID. But I think we want to keep some ammunition to be able to respond when we have another economic crisis. So we might not fall too low, but we certainly might see rates move back to where they were predominantly in the last couple of decades, maybe a percentage point lower.
That would, I think, be a very good summary of where things are at. It will not, the Fed can move their goalposts, and this seems like a situation in which they may choose to. And there are many arguments to be made that there is benefit to having a higher positive real rate of return. And I think I think personally that going back to what happened the last decade is probably not a positive for any type of investors. That will turn out to be, in history, an anomalous period versus a period we want to hold up as an example of what the Fed should be targeting. But we'll see, right? Like there are a lot of complexities associated with that. But also, if you look at economic growth has occurred and will occur in a variety of interest rates environments. Like if we settle out at 3%, there are plenty of times, like you said, in the 90s when we were around that and economic growth was great, right? It's not higher interest rates by and of themselves do not necessarily curtail growth. Like there's not a relationship that says, oh, our interest rates at 5% are going to tank the U.S. economy. It's very resilient to adjusting. Asset prices adjust, compensation adjusts, right? And as long as it's not, what's really hard for the economy is periods where we go up really quickly, down really quickly, right? If we can be steady at whatever the steady state level is, as long as it's not 20%, right, the economy is probably going to do just fine.
Yeah. Well, I'm gonna take a pause there, Kristi. We're coming up on an hour as far as
Yes.
our time check, and so I just wanted to see. We haven't had any other questions come in yet, but if there's anything you wanted to make sure that we covered before we wrapped up.
Yeah, I do. And for those of you, I understand we're at our 9:30. If you need to drop off, you will get a email with a recording of this if you want to watch the last couple minutes. But I will try to be quick in terms of wrapping up. In terms of I just wanted to have a couple more things to leave everyone with.
Beautiful.
So, if you've looked recently, bonds have continued to struggle from a total return standpoint. And I just wanted to make the point about the fact that we still think that bonds have a brighter outlook than they've had in a decade. And unlike stocks, actually the starting yield, meaning where we are today in terms of what bonds are going to pay out, and the subsequent return is actually much more predictable. So like price to earnings, I can tell you that it has this kind of loose relationship between future returns over 10 years. Bonds actually have a very predictable return in almost all the cases. These two outliers here from this line, those are high inflationary environments. So assuming we don't go back to some crazy inflationary environment, the starting yield generally is quite good at predicting the next 5 years or the next 10 years in terms of bond returns. This is where we were the past decade, right? Not great returns projected. We've moved up here. Now we're not up here, but also inflation is not up here. This is the 80s, right? Bonds are in the 5-ish% range if you take the expected return of the starting yield of the Barclays Agg. That's better than we have seen in a decade. So while you might be not feeling so good about the past quarter, the year to date, and we keep saying this, the outlook for bonds is still much brighter than it's been. And our understanding of translation between expectations and realization is much better than it is in stocks. So try not to despair about your bonds. They still have a very important place in the portfolio, and we still think you should continue to own them over like switching to a CD. The last thought I want to stay on a positive note is that there's been a lot of recent speculation about NVIDIA, about AI, and to date, the market has been really focused on very sort of niche AI. And so it starts with NVIDIA, right? That's one thing everybody's like, I want NVIDIA because AI is going to chips. This is a graph of other things between January of 2023 and April of 2024. So this doesn't include the last run up in small value. But you'll notice that there's a few interesting names that at least I'd never heard of. These aren't household names. Powell Industries, like what do they do? IES, Vertiv. We're starting to see the AI plan translate to a bunch of no-name companies that are starting to broaden who's going to benefit for these. Powell and IES are electronics power distribution companies. And I think it's super interesting to note them because they're actually a couple of holdings in AVUV, which is our US small cap value ETF. So while you might think that the AI stocks are all in that large US growth tech sector, and a bunch of them are, there are also plenty of small value brick and mortar. I think I looked up Powell Industries, I think was started in 1947, IES in 1997. These are not like your startup tech companies. These are other types of industries that are starting to go and benefit and deliver a lot of returns from sort of this move to AI. I think if I were to look forward, it's not inconceivable that the benefits of AI and people start to understand how that's going to benefit industries across the globe and in all kinds of sectors that the market hasn't yet fully digest it. So I think that's the case for don't just assume all the benefit of AI is in the large growth tech stocks. And also, we could hit a recession at any time. There could be another storm. And also, there's a lot of positive momentum for increased productivity, a lot of opportunities in other areas of the market that AI might benefit. And with that, I think we'll open it up for any last questions. And if not, thank you all so much for joining us. I hope you've gained some additional insight into your portfolio. And this recording will be available if you want to go back and look at anything or review it. Jeff, any final questions to close out with?
Thank you, Kristi. No, we are all squared away on questions from the group.
Wonderful. Well, take care, everyone. Thank you for joining.